Hi, this is Kerry from Commercial Loan Corporation. This video presentation is going to be learning the basics of using Proposition 58 to avoid reassessment of property taxes when transferring property held in an illiquid trust. This should take just about 8 minutes. When a trust holds real property and there are no or limited other assets, and one of the beneficiaries wants the real property as their share of the distribution, Proposition 58 requires that the trust be distributed evenly. That means that each beneficiary gets an equal amount. Now, how can the assets be divided equally when the only asset is real property? The trust must borrow enough money from a third party to pay the other beneficiaries in cash, an amount equal to the equity received by the beneficiary taking the real property. A basic calculation, assuming no other assets in the trust and no trust expenses, would be property value divided by the number of beneficiaries equals each beneficiary's share. Now here's an example using numbers. Property value of $900,000, 3 beneficiaries. That means each beneficiary will get $300,000. That's $900,000 divided by 3. So in this situation, beneficiaries A and B will both get $300,000 in cash, and beneficiary C will get $300,000 in equity. Here's how it's calculated. $900,000 in property value, $300,000 each for beneficiaries A and B leaves $300,000 in equity for beneficiary C. So the trust is going to need to borrow $600,000 to pay beneficiaries A and B. Now this is very simplified for explanation purposes. The trust may have expenses, they may have other assets, and we'll get into that with the calculator that we provide. Now, what are the different options for funding an illiquid trust? What is considered a third party? A family member, yes, conventional lender, family friend, private money lender, the acquiring beneficiary. Now, the only person that cannot put money into the trust and still keep the Proposition 58 exclusion for reassessment of property taxes is the acquiring beneficiary. In fact, the acquiring beneficiary can't even personally guarantee a loan from a third party into the trust because the Board of Equalization views that as a sibling buying out another sibling as opposed to a parent-to-child transfer. So let's look at these individually. A family member, as we talked about, is okay. A family friend is okay. The acquiring beneficiary, it's not permitted. The Board of Equalization views this as a sibling buying out a sibling as opposed to a parent-to-child transfer. A conventional lender. A conventional lender is a bank or a mortgage company. Now, almost all conventional lenders are going to require that the property be removed from the trust for funding. Now, this will likely cause a reassessment of the property taxes. In fact, I'm certain that in 99.999% of the cases it will cause a reassessment. A private money lender is okay as long as no personal guarantee is required by the acquiring beneficiary. A personal guarantee by the acquiring beneficiary, as we talked about, is viewed by the Board of Equalization as the same as a loan to the trust by an acquiring beneficiary or a sibling-to-sibling buyout as opposed to a parent-to-child transfer. Now, some conventional lenders will lend to trust with a personal guarantee, and this is okay if the one giving the personal guarantee is not the acquiring beneficiary. So basically, it's just the acquiring beneficiary is the only one that we have to be concerned about, not putting funds into the trust. Now that we know how to make an even distribution and where to get funding, does it always make sense to get a third-party loan? And the answer is no. There are costs involved with most third-party loans, and the acquiring beneficiary must keep the property long enough for the property tax savings to cover the third-party loan costs. So how do we determine that? Property tax savings. Now, in order to determine the property tax savings, we need the following information. We need the current property taxes, and we need to know the amount of the property taxes if the property were to be reassessed. The current property taxes can be found from a recent tax bill, property tax bill, or online. So determining the amount of annual property taxes if the property is reassessed. The percent of the property that will be reassessed will depend on the number of total child beneficiaries and the number of child beneficiaries taking the property as their part of the distribution. The majority of the cases will involve one child beneficiary taking the property, and so the following calculation is going to be using one child beneficiary taking the property. So what we're going to do is take 1% of the current value of the property. 1% is the tax rate, and usually that'll be a little bit higher than that, but we're going to use 1% just for explanation purposes. So take 1% of the current value of the property and divide that number by the number of child beneficiaries. And then we're going to multiply that number by the number of child beneficiaries that are taking cash instead of equity in this property. Let's call this number siblings reassessed portion. And then we're going to take the current property tax amount and divide by the total child beneficiaries. And then we're going to call this the acquiring beneficiaries portion. And so then we're going to add the siblings reassessed portion to the acquiring beneficiaries portion to get the reassessed property tax amount. Now keep in mind that only the non-acquiring siblings portions are reassessed. The acquiring beneficiaries portion is a parent-to-child transfer, so that's not going to be reassessed. Let's try it with some numbers. As we talked about, $900,000 property value, we're going to take a tax rate of 1%. The total number of children beneficiaries, 3. And we're going to say that the parents have owned the property for a long time and they're only paying $1,500 a year in property taxes. So $900,000 times 1% equals $9,000. I'm going to divide that by 3 because there's 3 beneficiaries. That's $3,000. Each beneficiary's share of the property taxes. And $3,000 times 2, since there's only 2 of the beneficiaries that are going to be taking cash, will be $6,000. We're going to call this the siblings reassessed portion. And then the portion that's not going to be reassessed, 1,500 divided by 3 equals 500. So 500 is going to be the acquiring beneficiaries portion. So we take the $6,000, which is a siblings reassessed portion, plus the $500, which is the acquiring beneficiaries portion. So the reassessed property tax amount will be $6,500. What will be the annual property tax savings? So the reassessed annual property tax amount of $6,500 minus the current annual property taxes of $1,500. Now this is the number that we're going to use Prop 58 to get for the acquiring beneficiary. So he'll keep his parents' low Prop 13 tax base. So $6,500 minus $1,500 equals $5,000. The annual property tax savings is $5,000. Now, does getting a third-party loan make sense in this situation? Well, let's look at it. The loan cost will generally be about 3% of the loan amount. So the loan amount is $600,000, as we talked about, and 3% of $600,000 is $18,000. So the annual property tax savings is $5,000. $5,000, $18,000 divided by $5,000 equals 3.6. So it's going to take 3.6 years for the annual property tax savings to cover the loan cost. So the property must be kept longer than 3.6 years for a third-party loan to make sense. So the bottom line is, it does make sense to get a third-party loan and keep the parents' low Prop 13 tax base if the acquiring beneficiary keeps a property longer than 3.6 years. If the acquiring beneficiary is not going to keep the property longer than 3.6 years, it probably doesn't make sense to do the loan. So we are a commercial loan corporation, and we do several of these third-party loans every month and understand the needs of the acquiring beneficiary, the trustee, and the attorney. But we are lenders, so please consult your attorney. We are experts in the loan process while your attorney is an expert in legal matters. We have a relationship with a gentleman, though, that worked in the Orange County Assessor's Office for 24 years before starting his property tax consulting firm. And he's available to answer any questions you may have about how specific transactions will be viewed by any California county assessor, or how to structure those transactions involving trust with other assets and real property. We also have some tools. We have a trust and estate loan benefit calculator, which is basically a break-even calculator, which shows you basically what we just went through in this presentation. What is the break-even point in my particular situation? And you can find this calculator on our website at www.cloanc.com. Now, we also have a trust distribution calculator, which is not on our website because it's Excel-based and it's a little bit too complicated to put on our website, but we can send it to you. We'll email it to you. This calculator will show expected distributions if the property is sold or is kept by one of the beneficiaries. So just call us at 464-1066 and we'll email you a trust distribution calculator. Now, if you want a copy of this presentation in a PowerPoint format, just call us at 877-464-1066 and we'll email you a copy. Again, we're a commercial loan corporation. Thank you.